Part 3, Chapter 3, Ratio Analysis and Statement Disclosure. Now, on the balance sheet, it is useful because it's used for computing rates of return, evaluating the capital structure, assess risk and future cash flows, and we can do analysis in terms of liquidity, solvency, and financial flexibility. What are the limitations? Most assets and liabilities are reported at historical cost. We use a lot of judgment in estimating things like allowance for doubtful and warranty reserves. And many items of financial value are omitted. An example would be if you had some key players in your industry working for you. Now, balance sheet classifications, we've already discussed these, but I'll go through it again. We have assets, we divide between current and non-current. The non-current we break down between long-term investments, property, plant, and equipment, intangible assets, and anything that doesn't fit in those categories. Remember, property and plant and equipment and intangible assets are used to produce revenue in the business. Long-term asset investments are not. Liabilities, we've got current and long-term or non-current, and we have equity. Now, a classified balance sheet helps inform users determine working capital and do ratio analysis. Now, liquidity. Liquidity most often refers to the ability of a company to convert its assets to cash to pay its current obligations. The first one we talk about is working capital. And all we do here, this is not a ratio, we just take our total current assets and subtract our current liabilities to see how much do we have left over to cover our long-term obligations. Then we have two other ratios. One's called the current ratio, which tells you for every dollar that you have in assets to cover what you have in liabilities. We have two, the current ratio, and we have the acid test. This number is always lower than the current ratio because it excludes certain things. The current ratio, normally the rule of thumb should be at least 2, depending on the industry you're in, and the acid test should come out at least at 1. So, the acid test. It provides a more stringent indication of a company's ability to pay its current obligation. The numerator excludes. We back out inventories, prepaid, and restricted cash. The numerator would include unrestricted cash, short-term investments, and accounts receivable. These are referred to as quick assets. So now let's take a look at an example. First, let's determine our working capital. So first we would look at our current assets. We would add those up and get 900. And this example, we only have one current liability. We subtract those and we get our working capital, which means we've got more than enough funds to cover our long-term obligations. Now, another way to look at this is the current ratio. In this case right here, we have, another way of looking at this is we have $2.25 in assets for every dollar we have in current liabilities. So that's not too bad, but you can't judge a ratio on its own. You have to compare it to industry averages, and every industry is different. The acid test. In this case, we have $1.37.5 for every dollar, which is not bad. So this company can meet its obligations and would be considered a going concern. Now, if you had a current ratio less than 1, then the going concern issue might be raised. Now, what if we had another problem here, and what are the and now we're going to work backwards using ratios. What are the short-term investments and returned earnings if the current ratio for the year is 2.1? So how do we figure this out? First, what we're going to do is categorize the current assets, short-term, and then solve for short-term investments and retained earnings. So this is what I like to do, is I do a little schedule, and I have put the current assets in one column and the current liabilities in another. And also you can see my assets don't equal my liabilities, so I know something's missing. Now the first thing we're going to do is this is what we have to solve for. So our current assets are these items. These are our current liabilities. Now, what we have is our current liabilities, so we have our denominator of 61,500, but we don't have our total current assets. All we have is 90,000, and what we don't have is the value to assign for short-term investments. We also know that the current ratio equals $2 to 1. So we're going to solve for it, and what we're going to do is take the 2 and divide take it times the 61.5, because we moved the 61.5 to the other side. Since we divided on one side of the formula, we have to multiply on the other. And we get 123 as our total current assets. Now, we're going to confirm the number by taking 123 and divide it by 61,500, and it gives us 2 to 1, which is what we had. Always try to confirm your numbers. Then we're going to solve for short-term investments. We take the 123 minus the 90, which gives us 33,000, and now we can plug that in. Now what we can do is solve for retained earnings. So we're going to take the 243,100, which is our total assets, and we're going to subtract it from the amount that is showing for liabilities. And that is going to give us 31.5. That's what we need. And now our assets equal liabilities, and we have solved for all of our numbers. Now let's look at other solvency ratios that you have to do in your homework. One is the debit to equity ratio. We take our total liabilities and divide by shareholders' equity. Now here's normally how it works is, liabilities you have to pay back. Shareholders' equity you don't. So you don't want to finance your company with all debt, and you probably want to make it so that it's less than 50%, because otherwise you're going to have trouble borrowing. Okay, so compares resources provided by creditors with resources provided by owners. Other things being equal, the higher the ratio, the higher the risk. Because if you finance with too much debt, you don't pay it, you can lose the company. The other is our times interest earned. It's net income plus interest expense plus income tax divided by interest expense. To remain solvent or take on more debt, a company needs to have funds available to pay interest charges. It comes as many times greater than interest expense. Creditors' interests are more protected than if income just barely covers this interest expense. So go back and look at our example. So we're going to look at our current liabilities, and we're going to divide by our total equity, which is our 750 plus our 400, and we get 65.2. I think that's a little high in my opinion, but again, in order for us to judge it, we'd have to look at industry averages and for that type of business. Now, times interest earned is 7.5. Again, for that information to be relevant, we really need to compare it to industry averages. Next, financial statement disclosure. We have two types. We have significant accounting policies, details key policies and methods, including inventory costings, depreciation methods, and revenue recognition. And then we have the issue of separate notes, events such as subsequent events, related party transactions, and errors or fraud, if relevant, are explained in a separate note. So now let's take a look at an example and see if we can apply this. Okay, we have all these issues and we have to determine, is it a significant accounting policy note or a separate note to the financials? Timing of recognizing revenue, I would say that would be A, because that really has to do with accounting policies. Information on related parties, that would be a B. Composition of PP&E, that would be a B. Subsequent event information would be a B. Measurement basis for certain financial statements, that would be an A. Important mergers occurring during the year, I would say a B. And defines cash versus cash equivalents, that would be an A. So that would be my assumptions, and you do have a homework problem like that. I hope that helped you, and this should finish chapter 3 for us.